Hello, beautiful people. Your boy here, Kakovidia. All right, greetings to everyone. I hope you're all good. All right, so this will be our final lecture session on cost and management accounting for the first semester, right? There are some parts of this course that I think we'll be doing it in the second semester. So in this session, we are going to talk about cost volume profit analysis, where we'll talk about the break-even point and then break-even points when taxes are introduced. So we talk about the break-even points in normal, talk about the break-even points when taxes are introduced. So basically, cost volume profit analysis is a build-up of marginal costing. So I told you that absorption costing will end at the previous session. From now up to the end of next semester, it's marginal. So let's proceed. So this session, we are going to look at the cost, the CVP equation, break-even, and then profit planning, contribution to sales ratio, and the margin of safety. We slightly talked about sales mix, right? And the multi-product mix, but I'm not sure it will be for this semester, right? So we are going to treat that one next semester, God willing. All right, so under this session, we are going to discuss and define the concept of CVP analysis and also identify the major issues that arise from CVP analysis and evaluate some of the approaches we can use to solve them. So many questions among others, such as the following, arises in businesses almost on daily basis, right? So whenever we are trying to do a business, we always think about what volume of sales should we make to achieve a target profit, right? Or what sales should we make so that we wouldn't actually make any profit at all? What should be the selling price so that we can achieve the targeted volume of sales? And also what effect has change in volume and or cost have on profit? So, and when we change output, what effect does it have on cost? That's what it is trying to say. What effect does it have on cost or on profit? So to answer these questions, managers study the links of relationship between cost, volume of product or of service sold, and then the profit, right? So even though these relationships are studied through cost volume profit analysis, CVP expresses the relationship among cost, volume, and profit or loss. It is useful for predicting future operations, future operating results, and therefore a key management tool for short-term operating decisions. So for example, a company using CVP analysis can find how much profit to make given a certain sales volume or decide a level of sales needed to achieve a certain level of profit. So in this session, we are going to talk about some stuff that will help us to understand all this. So called volume profit analysis model. So this is a model that helps managers make many important decisions, such as what products and services to offer, what prices to charge, what marketing strategy to use, what cost structure to maintain. So its primary purpose is to estimate how profits are affected by the following 5 factors: selling price, sales volume, units variable cost is supposed to be variable cost, total fixed cost, and then mixed products sold. I won't talk about mixed products sold. So this can come in our exams as objects. What are some of the uses of cost volume profit analysis? So basically, it helps us in determining break-even points, where we will talk about this very soon. It helps us to determine the selling price, which will give a target profit. It helps to determine the cost and revenue at different levels of output. It helps in determining the most profitable mix in the case of product mix. It shows the impact on increase or decrease in fixed cost and variable cost on profit. So when fixed cost and variable cost decreases or increases, what impact do they have on profits? It aids management decision making. It helps in determining cash requirements at different levels of operation with the help of cash break-even charts, where we'll talk about this soon, even though we didn't really go into details in class like that. It shows the effect of changes in selling price or price differentiation in different markets. So you see, almost every theory, right, have, or every model have some assumption. So you can see that in economics, for example, will be like all other factors held constant. This, and this. So here too, we have some assumptions that break-even analysis or CVP deals in. So CVP normally categorizes all costs into fixed and variable elements. Then sales price. So when you're dealing with CVP, your costs are always between fixed and variable, right? Selling price per unit remain constant at all level of activity. Production and sales are equal when we are breaking even. So can only apply to single product, focus or homogeneous product line or constant mix in multi-product companies. The mix of products sold remains constant. Fixed costs are same in total and unit variable costs remain the same at all level of output. So I'm sure this is the main reason why our lecture came and then refreshed our mind on cost estimation and prediction. So I think this is the reason why. So it's also steady state operations. The analysis, it helps in steady operations, steady state operations. So the analysis assumes that there are no significant shifts in market conditions, input cost or business operations during the period of steady. Linear cost and volume, linear cost and revenue functions. Cost and revenues are assumed to vary linearly with levels of production and sales volume. So there are some limitations to break-even analysis. So in real-life situations, all things being equal, things may be totally different, hence limitation. So key to short-term decision, contribution margin is a key. So it's aids in adding and dropping product lines and other segment decisions, special order pricing decisions. It helps in utilization of scarce resource or volume trade-off decisions. Joint product cost, it helps in aiding joint product cost and sell or process further decisions, and also make or buy. It also aids in make or buy decisions. So to tackle this soon. I mean, Sorry, let me continue. So, I don't read this one. So, contribution margin. So, when we talk about contribution margin, we just want to know how contributions, like how far the contribution is from the sales. So, basically, contribution margin is the amount remaining from sales revenue after all variable costs or variable expenses has been deducted. So remember when we were doing marginal costing, right? We were um whenever we after sales we subtract all variable expenses and then we get contribution margin. The same thing, that's the same thing here. So the amount that contributes towards covering fixed expenses. So the contribution is the amount that covers towards what covering fixed expenses and then towards profit for the period, right? So the contribution income statement is used as an internal planning and decision-making tool. It, its emphasis on cost behavior aids cost volume profit analysis, management performance appraisal, and budgeting. So it's basically same as the marginal costing statement income, right? So sales volume, the less variable cost, then we get our contribution margin, then we less fixed cost, then we get net income or loss. So there's some conversation, there's some conversation here that went on between Marina and Victoria, right? So it's more about the overview of whatever we are coming to do today. So Marina, who is an engineering graduate student at the time, started a business. The accountant, Victoria, had worked for several small companies where she had acted as a business advisor as well as accountant and bookkeeper. The following discussion occurred soon after Victoria was hired. So Mawena said, Victoria, I have a lot of questions about the company's finances that I hope you can help me answer. Victoria said, we are at a great shape. The loan from the family will be paid off within a month. Mawena, I know, but I'm worried about the risk I've taken on by expanding operations. What would happen if a competitor entered the market and our sales slipped? How far could sales drop without putting us into the red? So this is talking about margin of safety. We'll talk about margin of safety very soon. Another question I have been trying to resolve is how much of our sales would have to increase to justify the big market campaign the sales staff is pushing for, right? This is also the profit target in case of CVP. Victoria is saying that marketing always wants more money for advertising and promotion. Marina is saying, and they are always pushing me to drop the selling price on the products. I agree with them that a lower price will boost our sales volume, but I'm not sure that increased volume will offset the loss in revenue from the lower price. Sounds like these questions are all related in some way to the relationship among selling prices, our cost, and volume. I shouldn't have a problem producing some answers. Marina is now saying that, can we meet again in a couple of days to see what you have come up with? Victoria is saying, sounds good, but then I will have some preliminary answers for you, as well as a model you can use for answering similar questions in the future. The model is cost volume profit analysis. That's the savior. So basically, this conversation has said all about what we are coming to do today, right? So we move on to, let's talk about break-even point. So break-even point is a point where we are either not making profit or we are either not making a loss. So it is a point where profit is zero. So it can be in units or it can be in sales. Management might want to know what the break-even point is to identify the minimum volume of sales that must be achieved to avoid a loss. Assessing the amount of risk in the budget by comparing the budgeted volume of sales with the break-even volume. And that's the difference between the budgeted or the actual sales from the break-even is what we call the margin of safety. So break-even in single product scenario. So the break-even point can be calculated using the CVP analysis. At break-even point, profit is zero, as I've said earlier. Total contribution is exactly equal to total fixed cost. So meaning that after subtracting variable cost, you get, if let's say fixed cost is 2, contribution is 2. So when you subtract, everything will now be 0. That's what it means. We therefore need to establish the volume of sales at which fixed cost and total contribution are the same. So we have two methods of calculating break-even. So we can do it break-even point in units or break-even point in sales, where break-even point in units is equal to this. BEP is equal to fixed cost over selling price minus cost price per unit. So selling price per unit over cost minus cost price per unit, where the selling price minus the cost price is equal to contribution. But here, the cost we are talking about here is variable cost. Input variable cost here. Variable cost per unit. And the difference becomes contribution. Difference becomes contribution. Right? So basically what it means is that the break-even point in units is equal to fixed cost over contribution. So in some questions, they might give you contribution, then it means you are just putting it down there straight. Or in some questions, they will give you selling price and then the variable cost. Then you have to subtract and then get your contribution, right? But if you want to get the break-even point in sales, if you want to get the break-even point in sales, we can multiply it. We have two ways. We can multiply the break-even point in units by the selling price, right? So break-even point that we calculated in units by the selling price, and we get break-even point in value or break-even point in sales, right? Or we can also divide fixed cost all over contribution margin ratio, right? So contribution margin ratio, CMR, is equal to contribution all over sales or selling price, all over selling price times 100, right? Then you get a contribution. So when you divide the fixed cost by the contribution, you get the same break-even point in value or in sales, right? So let's move on. Quick. All right, so this is what I just explained. All right, so this is a question here, right? A question here. MBA Limited makes a single product that has variable cost of 12 and per unit selling price of 20. Item fixed cost is 600. It's 600,000, right? So if we want to get contribution will be equal to 20 selling price minus 12, the variable cost, which is going to give us 8. So CMR here will be equal to 8, which is the contribution over the total sales, 20 times 12, right? So if they want the volume of sales to get, okay, what volume of sales units is required to break even, right? So if you want to get it in value, then it is going to be the fixed cost, which is 600,000 all over. When we do this one, what are we getting? Let me put this quickly on the calculator. we are getting we are getting 0.4 here, or 40% with this, so 0.4. Right, so when we divide this by this 0.4, 600 divided by 0.4, 600 divided by 0.4, you will get 15, 1.5 million, 1.5 million, right? That is in sales, break-even point in sales. If you want it in value, then it is going to be, if you want it in units, it's going to be 600,000 all over the contribution, the selling price, which is 8, right? Which is going to give us 7,000, 75,000. That's it. See, it is easy, easy as peasy. So that's what they did here. See, break-even point in units is this. So if you want to prove, we just put that same unit in here. You see the break-even point in sales. That's it here. Got 1.5 million. We subtract our variable cost from it, get our contribution, we subtract, then you see our net income is 0, right? But in the case where a tax is introduced, right, we have to pay tax, then that's when we'll be making profit, and we'll talk about that soon. Talking about that. All right. All right. So in exams, they can ask you and then they will tell you to prove it. So when they tell you to prove it, all you do is you just come and then put the unit in here, because if you want to get revenue, selling price times the unit, and you're going to get your revenue. Then the same thing. Remember, variable cost per unit. So you are going to multiply by your unit and then get your total variable cost. So that's the same thing here. We did the same thing up there. So break-even point with a target profit before tax, right? So I'll try and then combine it after tax here. Management might want to know what the volume of sales unit target must be in order to achieve a target. So let's say management is planning to make a profit of 50,000, right? They know their sales, they know the sales target that they should make so that they break even. So what you're going to do, you just add your profit to that, right? So let me see, and okay, that's the same example here, right? So here, let me try and then bring whiteboard. So the volume of sales required must be sufficient to earn a total contribution. Oh, hurry up, lad. So remember the break-even point in units is equal to the fixed cost over the selling price minus the variable cost per unit, right? Which I said this one is contribution, right? That's when we get our break-even point where profit is zero, right? So that's where profit is zero. So if we want to make a target profit, if we want a target profit now, what it is going to be is that target profit is going to be fixed cost plus our target profit. So plus P all over selling price variable cost per unit. You see, it's simple. So super simple. Easy peasy simple. You get it? It's so simple. So now let's say we want to make a target profit of, let's say, 50,000. Let's say we want to make a profit target of 50,000. It's the example that we were using, right? Remember, first cost is 600,000. So let's put the same thing, 600,000 plus 50,000 all over. The selling price was 20 minus 12. The variable cost is 12. So this causes the thing to be 650,000 all over 8. And then this is going to give us 81250 units, right? So we can do the same thing by multiplying the selling price by this to get the sales revenue, or we can divide it by our contribution to sales ratio. Remember, the contribution to sales ratio, when divide the fixed cost by our contribution. So here it will not only be fixed cost, it will not be only fixed cost over contribution ratio, contribution margin ratio, no. To be fixed cost plus the profit all over the contribution margin ratio, right? So contribution margin initially was what? 0.4. Fixed cost is now, everything at the top is now going to be 650,000 all over 0.4. And we are going to get the same thing. Right? And the otherwise too is the same. If we multiply the selling price, which is 20 times 81250, we are going to get the same thing. If you are told to prove it, you just put the figures in there and then get it. So let me use this opportunity to introduce profits. So if you want the break-even point, if you want target profit, sorry, if you want target profit, where there is tax, because in this era, or whenever you are a business and you make profit, your profit is going to be taxed. So there will be introduction in profit only when there is profit target. Sorry, there will be introduction in tax only when there's profit target. So when there is break even, there is no tax, but when there's profit, there will be tax. So it is going to make the equation look like this. It's going to make the equation look like this. Fixed cost plus the profit target, right? Okay, so sorry for the lag. So because there will be an introduction of tax, now if we want to get our profit target, we have to divide it by 1 minus the tax. So our profit target will be, the thing will be fixed cost plus profit target over 1 minus tax all over the contribution, where the contribution is the selling price minus the variable cost per unit, right? So that is basically it when we are introducing profit. So you see something? Um, now, um, now let's assume that the fixed cost is still 600,000. And then I want to make a profit of 50,000. Then let's say the tax rate is 25%, which is the normal company corporate tax rate. So 1 minus 0.25, right? All over the selling price is 20 minus 12, right? So when we do this, we are going to get we're going to get 600,000 plus 666. Okay, let me use 67 all over. The contribution is going to be 8 to 8. So break-even point in units is going to be this. It's going to be 8,3,3,3 units. Right. When we divide the same thing by our contribution to sales ratio, we are going to get our sales revenue. Do you get it? So that is basically the overview of whatever we are going to do today. I've summarized it in here. Let's just go on the slides and see whether see something interesting. So I've treated everything here. If we want to prove it, you bring in your units, you multiply your selling price to it, you get your distance. So you see at the end, you are going to get your 40,000 profit, right? So proving it is it, you put it in the contribution income statement, where the units that you had in the break-even listing calculation, you bring it here, you multiply by the selling price, then variable cost to 12 times the units, then you get your variable cost. Then when you subtract, you get your contribution, and then the first cost will come in here. To subtract, you get your desired profit target. All right. So that's the same thing here. Then um cost volume profits is useful for cost control purposes. As expected, as as expected, costs could be compared with actual costs after CVP analysis before and after operation. In short, CVP analysis summarizes the effect of changes in an organization's volume of activities on its cost, revenue, and profit. Note that although the word profit appears in the term CVP analysis, CVP, the analysis is not confined to only profit seeking, right? We are not only using it for profit seeking organizations, but also for any. So managers in non-profit organizations also routinely use CVP to examine the effect of activity and other short-run changes on revenue and cost. it must be noted that cost behavior underlines the study of CVP relationship. Two most important issues arising out of CVP analysis are break-even, sales, and profit planning. So that's the profit plan that we just did, right? The profit target. And then the break-even is when profit is zero. Talked about this already. So this is basically the uh, break-even equation where sales is equal to total variable cost plus total fixed cost plus profit. You are going to get sales. If you want to get profit, you subtract the total variable cost from the total fixed cost, you get your profit. That's the same thing here. And again, same thing. So break-even point, profit is zero. So the same thing. We'll solve more questions. So this is the proof of the formula. So with the contribution to sales ratio that I've also treated this already, where I said selling price minus the variable cost per unit over selling price times 100, right? That will give us the percentage. But if you want the ratio is zero, you will not include the percentage. All right. So this is it. So it's uses of contribution to sales ratios. It is used to calculate total contribution. So contribution is equal to contribution per sales ratio or contribution sales ratio all over sales, right? So we talked about this already. Talk about this. I've summarized everything in that whiteboard. So let's talk about margin of safety. And I've even spoken about margin of safety, where I said it is the difference between your actual or budgeted sales from the break-even point. So it determines the extent or how far your normal sales is far from the break-even point. Where when you have a high margin of safety, it means you have you are safe so more. So let's say your break-even point is let's say your break-even point Yes, your break-even point is 3,000 units. And then your margin of safety is, let's say, 6,000. Sorry. So then your margin of safety in units becomes the 6,000 minus the 3,000. So let's say here is your break-even point in units, and here is your sales, your actual or budgeted sales. It is the difference. But let's say your break-even point is, let's say, 5,000, and your budgeted sales is 6,000. The 5,001 and the 6,000, this looks more dangerous because there's only 1,000 units here, right? It looks more riskier as compared to this one, which is 3,000, right? So this will have a bigger margin of safety than this. If you want to get a margin of safety in units, you multiply the margin of safety. If you want to get margin of safety in value, you multiply this by the selling price, and you get your margin of safety in value, right? So in units is the expected or actual sales in units less the break-even sales in units, right? So the same margin of safety in CDs is the margin of safety in unit multiplied by the selling price. That's what I've talked about. So here the break-even point in unit is going to be 9,000 minus 6,300. We are going to get, I think, 900 minus 630. And we are going to get, I think, 270. When we multiply it, that's the break-even point in units. The margin of safety in units. If you want to get in value, you multiply that 270 by 3, and then we get our margin of safety in value. All right, so that's it here. So margin of safety as a percentage is going to be that difference over the total distance. So that difference over the expected sales times 100. That is when we get the margin of safety as a percentage. So you have the slides, you can do more readings because now everything, we didn't really talk about the weighted average contribution. That's when it's like a mix of this thing. So we just spoke about between two bulls, which one's margin of safety is higher and the like. So not sure. And then we spoke about the graphs. So this graph, for example, I think we'll solve more questions to cover it, where this is our sales line, and then this is our total cost line. Where they meet becomes the break-even point, and any point above where they've met becomes the profit zone, and any point below where they've met becomes the loss zone. Margin of safety is the difference between the output units and then the break-even units, right? So unit will be horizontal, profit will be, or revenue will be vertical, right? So that's the same thing here. And there's also the contribution graph. So the revenue graph, this graph, for example, the cost profit graph will not really have variable cost in there. You can see it is total cost straight, and then there is fixed cost. So the difference here in here becomes the variable cost. But here there will be introduction of variable cost, where we are going to match the variable cost with what? The profits, or the selling price, right? The sales. We are going to match the variable cost to the selling price or the sales, and then get our contribution, right? Then we get this thing to here, the match. So this is basically it. Let me see whether there's something that we didn't touch. Because I've touched on everything through see something like arrow. I reading through this. I'm sure we'll do this next semester. And this is the profit targets that I spoke about, right? I've spoken about this already. So it's easy. It's easy, and you can try this illustration. We'll solve more questions very soon. Wish you all the best in the upcoming exams, and see you some other time. Right. Bye. These are basically doing all this, so skipping them. Yeah. So what we did is what I've showed you. That's it for today. See you some other time. Bye.